Hello traders! Welcome back to Com Lucro. Today, we're diving into a strategy that could make a real difference in your trading toolkit. We're not just looking at the MACD indicator alone, but exploring how it performs when paired with the 200-day EMA and essential price action levels. This isn't just about understanding an indicator, it's about crafting a robust strategy that has helped professional traders achieve consistent success in real markets. At Com Lucro, our goal is to provide you with the knowledge to make informed, strategic trading decisions. We're not about selling flashy promises or quick wins. Instead, we focus on sharing practical techniques that serious, accomplished traders use to grow their wealth sustainably. We've condensed these concepts for you, bringing the most valuable insights in the shortest possible time. So, if you're ready to take your trading skills to the next level, stay tuned. Some key tips are coming up that you won't want to miss. And remember, we have other videos covering different strategies, so be sure to explore those and visit our website for even more in-depth resources. After this brief introduction, we'll jump straight into the details, so stay tuned.
Hey traders! If you're looking to level up your trading game, give this video a thumbs up, subscribe to the channel, and hit that notification bell so you never miss an update. Before we dive in, we highly recommend checking out our playlists on trading psychology and risk management. These videos can significantly help you manage emotions, maintain discipline, and develop effective risk management strategies. Key elements for achieving profitability in trading. Please listen, and remember, no amount of study to find the perfect trading strategy will benefit you if you lack emotional control during your trades. If you cannot accept a losing trade and keep moving your stop loss, or worse, trade without a stop loss, you are setting yourself up for failure. The efficiency of your strategy is directly tied to your risk management and emotional discipline. Only when a trader understands and implements this can they start seeing consistent profits and end their months in the green. Without these critical elements, even the best strategies will crumble under poor execution and emotional decision-making. Now let's get started.
Let's start with the basics. What is the MACD? The MACD, or Moving Average Convergence Divergence, is one of the most widely used technical indicators among traders, and for good reason. At its core, the MACD helps identify trends in the market by analyzing the relationship between moving averages. It's a tool designed to highlight potential turning points in price action, giving traders an edge when it comes to timing their entries and exits. Now, if you're an experienced trader, chances are you've already come across the MACD or even used it in your trading strategies. But here's the thing. While the MACD on its own is a solid indicator, it's not a magic solution. Used by itself, it provides decent insights, but when paired with other tools, its performance can dramatically improve. That's why it's essential to stick around for the full video, as I'll show you how combining the MACD with additional indicators can take your analysis to the next level. But before we dive into advanced strategies, let's focus on getting the MACD onto your chart. To get started, head over to TradingView or any charting platform you prefer. Locate the Indicators tab at the top of your screen, type MACD into the search bar, and select the first option that appears. With the MACD now added to your chart, it's time to understand how it actually works. The MACD consists of 4 key components that work together to provide insights into market trends and momentum. The MACD is composed of 4 primary elements: the MACD line, the signal line, the histogram, and the zero line. Let's break these down. First, there's the MACD line, which is typically displayed as a blue line. This line represents a 12-day exponential moving average, EMA, and reflects the shorter-term momentum in price. Then, we have the signal line, often shown in orange, which is a 26-day EMA. This acts as a smoothing mechanism, helping to identify potential crossover points with the MACD line. Next, we have the histogram, which visualizes the difference between the MACD line and the signal line. When the two lines move closer together, the histogram shrinks, and as they move farther apart, it grows. For example, when the MACD line crosses above the signal line, the histogram turns green, signaling bullish momentum. Conversely, when the MACD line crosses below the signal line, it turns red, indicating bearish momentum. Finally, we have the zero line, which serves as the baseline for the MACD indicator. This central point helps identify whether the market momentum is shifting positively or negatively. Together, these components provide a clear picture of the market's trends and potential turning points. Now that we understand the 4 components of the MACD, let's dive into how to use them effectively. The MACD is incredibly powerful for identifying trends in the market. One of the clearest signals it provides is the crossover between the MACD line and the signal line. For instance, when the MACD line crosses above the signal line, it suggests upward momentum, signaling a potential trend reversal or continuation to the upside. On the other hand, when the MACD line crosses below the signal line, it indicates downward momentum, pointing to a bearish trend. The histogram adds even more insight by showing the strength of this momentum. If the histogram is growing larger, it signals increasing momentum in the direction of the trend. Conversely, if it's shrinking, momentum is weakening. Here's how you can use this in practice. To enter a buy trade, look for an upward crossover of the lines. However, this signal is most reliable when the crossover happens below the zero line, indicating a potential bullish reversal. To enter a short trade, watch for a downward crossover, but only if it occurs above the zero line, signaling bearish momentum. If the crossover happens on the wrong side of the zero line, for example, an upward crossover above the zero line or a downward crossover below it, it's often better to avoid entering a trade. While the MACD is incredibly simple and effective, many traders face challenges because they rely on it in isolation. Combining the MACD with other tools or indicators can significantly improve accuracy and help avoid false signals, which we'll explore next. Let me explain why relying solely on the MACD can sometimes lead to problems. The MACD works exceptionally well when the market is trending. For instance, in an upward trend, the MACD accurately signals when the price is likely to continue rising, making it a valuable tool for spotting momentum shifts. However, the challenge comes when the market is in a downward trend or even moving sideways. In these cases, the MACD may still signal a buy opportunity, even though the price continues to decline. This mismatch can lead to losses if you don't account for the broader market context. So, how can we fix this? It's actually quite simple. If you're trading long, only take trades when the market is in an uptrend. Avoid trading against the trend because the odds will almost always work against you. A quick way to determine the market's trend is by adding a 200-day moving average to your chart. If the price is consistently above the 200-day moving average, the market is likely in an uptrend. If it's below, the market is in a downtrend. This straightforward adjustment can significantly improve the reliability of your MACD signals and help you trade with the trend rather than against it. To set this up, head to the Indicators tab on TradingView and search for EMA, which stands for Exponential Moving Average. Select the top option from the list. Once you've added the EMA to your chart, click on its settings icon to customize it. Under the Input section, change the length to 200, transforming it into a 200-day exponential moving average. Next, switch to the Style tab. You can choose any color for the EMA line to make it stand out. We at ComLucro typically prefer purple or red, but feel free to use a color that works for you. Once the EMA is set up, you'll notice a single line on your chart. This line serves as a trend filter. If the price is above the EMA, it signals the market is in an uptrend. If the price is below the EMA, it indicates a downtrend. This simple visual aid makes it easy to align your trades with the prevailing market trend, significantly improving your trading decisions. Now that we've covered the basics, let's put it all together into a powerful strategy. If you're going long, the first rule is to only trade in an uptrend. Here's how it works. You place a buy trade when the MACD line crosses upward below the zero line, and the current price is above the 200-day moving average. This ensures you're entering trades only when the market is in an uptrend, significantly increasing your odds of success. For short trades, the process is the exact opposite. You enter a short trade when the price is below the 200-day moving average, and the MACD line crosses downward above the zero line. Let's look at an example. We'd want to take a long trade at this point because the MACD lines are crossing upward below the zero line, and the price is comfortably above the 200-day moving average. To manage risk, we at ComLucro recommend setting a stop loss just below the 200-day moving average. This way, the 200-day moving average acts as a kind of wall that the price needs to break through to hit the stop loss, providing an extra layer of protection. For the profit target, ComLucro, we generally aim for a 1.5 profit ratio, meaning the potential profit is 1.5 times the risk. As shown in this example, the strategy worked perfectly, delivering a clean and profitable result. Combining the MACD with the 200-day moving average creates a robust system for filtering trades and improving your overall accuracy. We've made money with this strategy, but there's always room for improvement. While combining the MACD with the 200-day moving average works incredibly well in trending markets, it can struggle when price action begins to move sideways or loses momentum. For example, in this scenario, the chart is moving sideways with little to no upward momentum. As a result, the MACD generates several false signals, leading to potential losses. If you traded during such conditions, chances are you'd lose money. So, how do we fix this? By adding price action to the strategy. Here's how it works. Identify key support or resistance levels. Look for areas on the chart where the price has previously bounced or reversed. For instance, in this example, the price drops, hits a support level, and reverses upward. Wait for the price to return to the same level. Once the price revisits this key support or resistance, it's a potential area for a reversal. Now, it's important to note that while support and resistance are useful tools, they're not foolproof. A support level that held in the past might break if the price has enough momentum to push through it. To increase confidence in the trade, this is where the MACD indicator becomes essential. Follow these steps. Ensure the price is above the 200-day moving average, confirming the market is in an uptrend. Wait for the price to hit the identified support level. Finally, watch for the MACD lines to cross upward below the zero line. This crossover is your signal to enter the trade, as it indicates a potential momentum shift in the price's favor. By combining the MACD with price action and the 200-day moving average, you create a strategy that is better equipped to filter out false signals and improve accuracy, even when the market starts to consolidate. In conclusion, we've developed a comprehensive and high-probability trading strategy by combining the MACD, the 200-day EMA, and key price action levels. Start by adding the MACD to your chart and understanding its components, which will help you identify potential trends and momentum shifts. Next, use the 200-day EMA as a trend filter to confirm the market's overall direction and eliminate trades that go against the broader trend. Finally, incorporate support and resistance levels to refine your entries and exits, especially in sideways or range-bound markets. By combining these three elements, the MACD, the 200-day EMA, and key price levels, you're building a strategy that aligns with the market's momentum, enhances trade accuracy, and reduces the risk of common trading mistakes. If you found this strategy valuable, share your thoughts or experiences with the MACD in the comments below, or feel free to ask any questions about this setup. We'd love to hear from you. Thanks for watching, and we'll see you in the next video here at ComLucro.
I hope you enjoyed today's video. If you found the content useful or fun, please give it a like, as this helps the video reach more traders like you. Remember to subscribe to the channel and activate notifications to stay updated with the latest financial market information and trading tips. Sharing this video with your friends or on your social networks can make a big difference and helps our community become stronger. Your support allows us to continue bringing high-quality content, helping you make more informed decisions in the markets. Thank you for watching, and good luck on achieving excellent results in your trades.